Welcome to the weekly market wrap-up. I'm Hannah Bernard. After several days of flatlining performance, the market saw a broad sell-off, with the three major indices moving in sync for the first time this year. Is this a sign that investors need to begin hedging their bets, or will the equities shake off this funk? Let's get to it. Thursday was a volatile day on Wall Street as the Dow dropped nearly 200 points during the session before closing at 16,197, leaving it down 1.07%. This was one of the worst one-day performances for the Dow since August of last year, and one that caught many pundits and investors off guard. Adding more fuel to the fire, 90% of stocks traded in the benchmark S&P 500 suffered losses, closing at 1,828, while the hot-flying NASDAQ Composite Index saw a notable correction, down 0.57%. Canadian markets didn't fare much better. The TSX Composite Index dropped 55 points on Thursday, maintaining its volatile trend. And the TSX Venture Exchange was the only one to close up with a small change of 2.95. Big news this week was China, where HSBC's survey of their manufacturing data fell to the lowest point since July, which suggests a deflation in the entire sector. Earlier this week, China reported its lowest annual economic growth since 1999. Now closer to home, several U.S. companies fell after posting disappointing earning results, a list which includes American Eagle Outfitters, which reported weak holiday sales this season. The softening of the consumer retail sector has been a trend that we have been following, and the divergence between equity valuation and real-time economic data suggests that investors need to carefully tread water during what may be a turbulent year. This sentiment is confirmed by Peter Schiff, who we caught up with for an exclusive interview at the 2014 Cambridge House Investment Conference on Monday.
Nobody expected those numbers out of Best Buy because everybody believes in the hype of this recovery. But I know the recovery is an illusion. It doesn't exist, and I think the Best Buy sales show that average Americans are not benefiting from this bubble that the Fed has inflated. They don't own stock. They don't even own houses anymore. They're renting, and their rent is going up. But quantitative easing is also making the cost of energy go up, the cost of food go up, healthcare costs are going up, insurance costs are going up, taxes are going up. The only thing that isn't going up are paychecks. A lot of people don't have any because they're unemployed, or if they do, they're underemployed and they're getting a smaller check. Meanwhile, the cost of living is going up. The government doesn't want to acknowledge that. So I think we're going to have a lot more disappointing numbers coming out of the retailers.
Now to winners and losers and our picks for the week. The winner for this week is BlackBerry. Now there's something you don't see very often, with the ticker symbol BBRY. The 8.5 share jump rides off the tails of an announcement that the Canada-based company will sell off a majority of its real estate holdings in its domestic market, a move that seems to have investors beginning to warm up to the new CEO's refocus. This year, BlackBerry has been a surprise, considering the consumer fondness for touchscreen smartphones and tablets. Yet the numbers don't lie. Year to date, shares are up 43%, and we still have 11 months to go. And in the loser slot this week is Advanced Micro Devices, ticker symbol AMD. Shares fell 12% midweek after a poor earnings report showed a decline in sales amidst a very soft PC market in the fourth quarter. AMD has been suffering an inverse turnaround since the start of the new year, as it was one of our undervalued picks of 2013. This highlights the extreme sentiment velocity of the markets and the necessity of taking profits off the table as a proper trading discipline. That's enough about this week. Now let's turn to BayStreet.ca's look at the week ahead and a snapshot of what analysts are forecasting for companies whose earnings reports are coming out next week. Here are 3 U.S. stocks to watch. On Monday, Caterpillar Inc. comes out with an EPS estimate of $1.29. Company officials urged Congress last week to develop federal surface transportation reauthorization legislation in order to boost U.S. infrastructure. This was good news for Caterpillar, enabling them and others alike to compete globally. On Tuesday, American Airlines comes out with an EPS forecast of 68 cents. Last week, American Airlines and U.S. Airways began to offer their customers improved access to the combined company's global network through the first phase of code share, which enabled customers to book flights on both airline networks. And last for the week, on Wednesday, Dow Chemical comes out with an EPS forecast of 43 cents. The Connecticut-based company announced in mid-January a partnership with Coda Distribution Group. Checking in on Canadian stocks to watch next week. Two companies to watch on Monday. First is AGF Management Ltd. with an EPS estimate for the quarter of 13 cents. The AGF Tiger roared ahead last year, reporting total fee-earning assets under management of $35.5 billion, or 3.2% increase from November 30th, 2013. Second on Monday is Richelieu Hardware Limited with an EPS estimate of 64 cents. In December, Richelieu announced a bid to purchase up to 1 million of its common shares. And Wednesday has Potash Corporation coming out with an EPS estimate of 31 cents. Late last year, the company announced cuts to its workforce in Canada and the United States and Trinidad by approximately 18%. And that wraps it up. Thanks again so much for joining us for another weekly market wrap-up. Before you head out for the weekend, make sure to subscribe to our YouTube channel and find us on Facebook and on Twitter. For Viral Network News, Crush the Street, and BayStreet.ca, I'm Hannah Bernard.